There is a single number, a financial metric so powerful, so revealing, that it acts as an X-ray, allowing you to see through the noise of the market, past the confusing headlines and the slick corporate presentations, and into the very soul of a business. It is the number that separates the fragile, debt-fueled pretenders from the truly great, enduring enterprises. It is the number that formed the bedrock of Warren Buffett's transformation from a clever bargain hunter into the world's greatest compounder of wealth. And by the end of our time together, this number and the profound philosophy behind it will become the most powerful tool in your own financial arsenal. It's called return on equity, or ROE, but understanding its name is simple. Mastering its true meaning is the key to unlocking a lifetime of intelligent investing. Most investors, perhaps even you, have been taught to look at the wrong things. We are drawn to soaring revenues, exciting new products, and a stock price that seems to defy gravity. We are told stories. But stories can be deceiving. A business can grow its sales to the moon while destroying the very capital entrusted to it by its owners. A company can appear wildly profitable, only to shatter at the first sign of an economic tremor. The path of the average investor is littered with the wreckage of companies that told a good story but possessed a rotten core. This metric, this single percentage, cuts through the narrative and reveals the truth. It answers the most fundamental question an owner can ask. For every dollar of my own capital that I have invested in this enterprise, how many cents of profit does the business generate each year? It is the ultimate measure of efficiency, of managerial skill, and of a company's ability to turn its own substance into ever-increasing value. We are about to embark on a journey deep into the heart of the Warren Buffett method, a journey that will fundamentally change the way you perform stock analysis. We will deconstruct this powerful concept into 5 distinct pillars, building a complete mental model that you can apply immediately. We will begin by understanding the core philosophy, the simple, elegant truth that ROE reveals. Then, we will travel back in time to witness the very moment this idea transformed Buffett's own career, through the story of a humble candy company. We will confront the dark side of this metric, learning to unmask the dangerous deceptions that fool 99% of investors. From there, we will explore the beautiful mechanics of the compounding engine, seeing exactly how high ROE fuels exponential portfolio growth. And finally, we will assemble all of this knowledge into a practical, step-by-step guide, an investor's X-ray you can use to screen for the world's greatest businesses. This is not just a lesson in financial ratios, it is a masterclass in quality investing, a blueprint for achieving financial freedom by learning to think like the world's most successful capitalist. Let's begin with the core philosophy, the very foundation upon which this entire strategy is built. Understanding what return on equity truly measures. To grasp this, we have to travel back to the early days of Warren Buffett's career, long before he was the Oracle of Omaha, when he was a young, hungry fund manager scouring the backwaters of the stock market for bargains. His teacher, the legendary Benjamin Graham, had taught him an approach that was both simple and powerful. Buy stocks for far less than they were worth, what he famously called cigar butt investing. The idea was to find a discarded cigar butt on the street that had one last, free puff left in it. In business terms, this meant finding companies trading for less than their net working capital, essentially buying $1 for 50 cents. It was a strategy that worked, but it had a profound limitation, a lesson Buffett would learn the hard way through a company called Dempster Mill Manufacturing. In 1956, Buffett's partnership began aggressively buying shares in Dempster, a sleepy manufacturer of windmills and farm equipment in Beatrice, Nebraska. The company was cheap, a classic cigar butt. It was trading at a massive discount to its liquidation value. Buffett eventually gained control of the company, installed a new, hard-nosed manager named Harry Bottle, and proceeded to do what any good Graham-style investor would. He squeezed the last puff out of the cigar. Bottle was ruthless in his efficiency. He slashed costs, sold off excess inventory, closed unprofitable plants, and generated a huge amount of cash from the company's assets. On paper, it was a spectacular success. Buffett's partnership made a handsome profit. but the experience left a sour taste in Buffett's mouth. The underlying business itself was terrible. It operated in a brutally competitive industry with low profit margins. It was a business that required constant capital investment just to tread water. Once all the excess capital was squeezed out, what was left was a fundamentally poor business. He realized that a business like Dempster Mill was a constant struggle. You made your money on the purchase, by buying it cheap, but the business itself never helped you. In fact, it was an anchor. This experience planted a crucial seed in his mind. What if, instead of buying a terrible business at a wonderful price, he could buy a wonderful business at a fair price? What if, instead of a business that consumed capital just to survive, he could find one that gushed cash and generated high returns on the capital it employed? This was the intellectual shift that led him away from the cigar butts and toward the search for quality. It was a shift from focusing only on the balance sheet, what a company's assets were worth, to focusing on the income statement, and more importantly, the connection between the two. He began to ask a different, more powerful question. Not just, what is this business worth if I liquidate it, but how good is this business at growing its own worth as a going concern? And the single best metric to answer that question, he discovered, was return on equity. This shift in perspective is rooted in a deep psychological principle, a mental model that separates the world's greatest investors from the crowd, the power of simplicity, often articulated through the philosophical razor known as Occam's razor. The principle states that among competing hypotheses, the one with the fewest assumptions should be selected. In the world of investing, a world drowning in complexity, a world of arcane financial instruments, convoluted valuation models, and impenetrable jargon, investors are constantly tempted to believe that the secret to success must be equally complex. They fall prey to a kind of intellectual vanity, believing that by mastering the most difficult formulas and the most obscure data points, they will gain an edge. They build spreadsheets with dozens of variables, listen to economists predict the unpredictable, and chase after intricate narratives about technological disruption or macroeconomic trends. But this is often a trap. The complexity creates an illusion of control while obscuring the simple, fundamental truths that actually drive long-term returns. Return on equity is the ultimate application of Occam's razor to the world of finance. It slices through the noise and asks one simple, devastatingly important question. Are the managers of this company any good at their jobs? The job of a manager, the fundamental purpose of a corporation's executive team, is to act as a steward of the owner's capital. That capital is the money shareholders have invested, plus all the profits the company has retained over its entire history. This is the equity in return on equity. The manager's job is to take that pool of capital and generate a profit, a return. ROE measures how well they do it. A high ROE means the management is skilled at deploying capital into profitable projects. A low ROE means they are not. It's that simple. Adopting this mindset requires a psychological shift from thinking like a speculator to thinking like an owner. A speculator looks at a stock as a flickering blip on a screen, a piece of paper to be traded based on charts, news, and sentiment. An owner looks at a stock as a fractional interest in a real, living, breathing business. When you think like an owner, you stop caring about the market's daily mood swings and start caring about the underlying operational performance of your business. You ask questions an owner would ask. Is my business profitable? Is it growing? Is it managed well? ROE provides a clear, concise answer to all three. It forces you to ignore the distracting stories and focus on the economic reality. This is a profound defense against the most common behavioral biases that plague investors. It bypasses the herd mentality that chases popular stocks regardless of their fundamentals, and it grounds you in the concrete reality of business performance, protecting you from the seductive but often hollow narratives that lead so many astray. So how do we make this powerful, abstract concept intensely practical? we can translate it into an applied mental model, a simple blueprint I call the business in a box. Imagine for a moment that you are not buying a tiny fraction of a global corporation, but that you are going to buy a small, local business in its entirety. Let's say you have the opportunity to buy one of 2 laundromats in your town. The owner of Laundromat A is retiring and wants to sell. You do your due diligence. You calculate that to buy the machines, the lease, and the inventory, you would need to invest a total of $100,000 of your own money. This is your equity. After looking at the books, you determine that after all expenses, water, electricity, soap, maintenance, rent, the business reliably generates $10,000 in profit each year. What is your return on equity? It's simple. $10,000 of profit divided by $100,000 of equity. Your ROE is 10%. For every dollar you've put into the business, it gives you back 10 cents in profit each year. Now, let's look at Laundromat B, located across town. The owner is also retiring. This laundromat is a bit more modern. The machines are more efficient, it's in a slightly better location, and it has a loyal customer base. To buy this business, you would need to invest the same $100,000. This is your equity. However, when you look at the books for Laundromat B, you see that it generates $20,000 in profit each year. Its return on equity is $20,000 divided by $100,000, which equals 20%. Now, as a prospective owner, which business would you rather have? The answer is obvious. Laundromat B is fundamentally a better business. It is twice as efficient at turning your capital into profit. Even if both businesses were offered to you for the same price of $100,000, Laundromat B is vastly superior. But here is where the stock market confuses people. Imagine a slick stockbroker comes to you and says, "I can get you a deal on Laundromat A. The owner is desperate. You can buy it for only $80,000. It's 20% off." Many people, trained to look for bargains, would jump at this. It looks cheap. They're getting $100,000 worth of assets for $80,000. This is the cigar butt approach. But the intelligent owner, the one thinking in terms of ROE, would pause. Yes, it's cheaper, but it's still a 10% ROE business. Laundromat B, the 20% ROE business, might be selling for its full price of $100,000, or maybe even a little more, say $110,000. The average investor would say it's too expensive. But the Buffett-style investor understands that it is far better to pay a fair price for a wonderful business, a 20% return machine, than to get a bargain on a mediocre one. Over time, the superior economics of Laundromat B will generate far more wealth, as it can reinvest its profits at that high 20% rate, compounding your capital at a much faster speed. This simple business-in-a-box mental model is the key. Every time you analyze a stock, you must strip away the ticker symbol and the stock chart and visualize it as a local business you are considering buying in its entirety. Calculate its ROE and ask yourself, is this a 10% laundromat or a 20% laundromat? This single question will bring more clarity to your executive decision-making than any other. To fully appreciate the wisdom of this approach, we must dedicate some time to exploring its opposite, what I call the antithesis, the path of the 99%. This is the path most investors walk, a path paved with exciting stories, dazzling revenue figures, and ultimately devastating financial losses. The most common mistake, the cardinal sin, that the ROE metric is designed to prevent, is falling into the, quote, top-line trap. The top line of an income statement is revenue, or sales. It's the biggest number, the one that companies love to trumpet in their press releases. Our sales grew by 50% this quarter. It sounds impressive. At the end of the year, that $200 million is added to the shareholder equity account. So the company starts the next year not with $1 billion in equity, but with $1.2 billion. It now has a larger capital base. Because it's a great business that can consistently earn a 20% return on its equity, In the following year, it is projected to earn 20% on this new, larger base. 20% of $1.2 billion is $240 million. The company has not only grown its profits, but it has accelerated its rate of profit growth. This is the engine of compounding at work, directly visible on the financial statements. The shareholder equity, the real net worth of the business, is growing at a rapid clip, driven by the high return it generates. Over time, the stock price must, inevitably, follow the growth in this underlying intrinsic value. A company with a low ROE of, say, 5%, that also starts with $1 billion in equity, only generates $50 million in profit. Its book value grows at a snail's pace. The financial advantage of owning the high ROE business isn't theoretical. It is a mathematical certainty that manifests as a faster-growing net worth, which ultimately fuels superior portfolio growth for its shareholders. This is the direct financial connection that turns an accounting ratio into a powerful engine for wealth management. The intellectual leap from a good investor to a legendary one often hinges on a single transformative experience. For Warren Buffett, that moment of epiphany arrived not in a bustling Wall Street boardroom, but in the quiet consideration of a West Coast confectioner. The year was 1972, and Buffett and his partner, Charlie Munger, were presented with an opportunity to buy a company called See's Candies. On the surface, it seemed to violate every rule they had learned from their mentor, Benjamin Graham. The asking price was $25 million. The company's tangible assets, its factories, its stores, its inventory, were only worth about $8 million. This meant they would be paying a $17 million premium over the book value. For disciples of Graham who preached buying assets for pennies on the dollar, this was heresy. Buffett's initial reaction was to dismiss the deal. Paying 3 times book value for a box of chocolates company? It felt extravagant, a foolish departure from the cigar butt strategy that had served him so well. But Charlie Munger, the intellectual partner who would so profoundly shape Berkshire Hathaway's destiny, urged him to look deeper. And as they did, they discovered a business that was unlike any they had encountered before. See's Candies was not just a collection of assets, it was an institution in California. It possessed a brand that was woven into the fabric of family traditions and holidays. Customers didn't just buy See's chocolates, they trusted them. This trust, cultivated over decades, gave the company an extraordinary power: pricing power. Each year, the managers of See's could raise the price of their chocolates by a little bit, and customers would barely notice, or, if they did, they would happily pay. The rise in price went almost entirely to the bottom line, as the cost of sugar and chocolate didn't rise nearly as fast. The result was a business with a phenomenal return on equity. The company generated about $2 million in after-tax profit on its $8 million of equity, an ROE of 25%. Furthermore, the business required very little new capital to grow. To open a new store was relatively inexpensive, and the brand loyalty was so intense that the business was a gusher of cash. It produced far more money than it needed for its own operations. After much deliberation, they made the $25 million purchase. It was the single most important decision in Berkshire Hathaway's history. See's Candies became their template for a dream business. It taught them that the most valuable asset a company can have is often an intangible one, like a brand or a reputation, that doesn't appear on the balance sheet at its true worth. It taught them that a business that can grow and increase prices without needing to invest huge sums of new capital is a compounding machine. That initial $2 million in annual profit has since grown immensely, and over the decades since its purchase, See's has sent more than $2 billion in pre-tax earnings to Berkshire's headquarters in Omaha. That $25 million investment was repaid many times over, and the cash it generated year after year provided the fuel for Berkshire to buy other wonderful businesses. See's Candies was the real-world proof that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. It was the expensive but invaluable education that forced Buffett to shed the last vestiges of his cigar-butt thinking and embrace the philosophy of quality investing that would make him a legend. The See's Candies story is a powerful illustration of a critical psychological principle that holds most investors captive: anchoring bias. This is our cognitive tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. For Buffett and Munger, their anchor was the teachings of Benjamin Graham. They were anchored to the concept of book value, to the idea that the only true path to investment safety and success was to buy assets for significantly less than their tangible worth. The idea of paying a premium, of paying 3 times book value for C's, felt viscerally wrong because it required them to pull up this deeply embedded mental anchor. For the average investor today, the anchors are different but no less powerful. Many are anchored to a stock's past price. They see a stock that has fallen from $100 to $50 and think, "It's cheap, it's 50% off." They are anchored to the old high price, using it as a reference point for value, when in reality, the business might have deteriorated so much that $50 is still wildly expensive. Others are anchored to valuation metrics they've heard about, like a low price-to-earnings ratio. They'll only buy stocks with a P/E ratio below 15, for example, believing this single metric is the key to finding bargains. This causes them to overlook incredible businesses like See's Candies or Coca-Cola, companies with such superior economics that they will likely never trade at a statistically cheap P/E ratio. Breaking free from these anchors requires a profound psychological shift. It requires moving from a static view of value to a dynamic one. The See's Candies purchase forced Buffett to do just that. He had to stop looking at the business as it was on that single day in 1972 and start envisioning what it could become over decades. This unlocked another powerful mental concept, the scarcity heuristic. We tend to place a higher value on things that are rare or scarce. Munger helped Buffett realize that a business like See's Candies, with its durable brand, its pricing power, and its incredible returns on capital, was an exceptionally rare economic asset. There are thousands of mediocre commodity-like businesses in the world, the Dempster Mills of the world. There are only a handful of truly wonderful businesses. This scarcity makes them incredibly valuable, and like a rare piece of art or a beachfront property, they are worth a premium price. The lesson for us is to consciously identify our own mental anchors. Are we anchored to a past stock price? To a simplistic valuation rule? To the idea that we can only make money by buying what is cheap and hated? Recognizing these anchors is the first step. The second is to actively seek out evidence that challenges them, just as Munger challenged Buffett's initial reluctance. This means focusing not on the price tag alone, but on the quality of the merchandise, the underlying long-term economics of the business, so elegantly captured by a high and sustainable return on equity. This insight into the value of a rare, high-quality business leads us to a practical, applied mental model that every investor must master: the economic moat evaluation. The term, popularized by Buffett, is a perfect metaphor. A medieval castle was protected from its enemies by a wide, deep moat filled with water. The wider the moat, the more difficult it was for an invading army to attack the castle. In business, the castle is the company's profitability, its high returns on capital. The invading armies are its competitors. An economic moat is a durable competitive advantage that protects a company's profits from being eaten away by competition. See's Candies had a massive moat. A high and sustainable return on equity is often the clearest evidence that a strong economic moat exists. A company without a moat that earns high profits will quickly attract competitors who will copy its product, undercut its prices, and drive those high returns down to average levels. Only a company with a protective barrier can maintain high profitability year after year. The blueprint for identifying these moats involves looking for 4 primary sources. First, a strong brand identity. This is the moat See's Candies had. Think of Coca-Cola, Nike, or Apple. Their brands create an emotional connection and a perception of quality in the consumer's mind, allowing them to charge premium prices. A customer buying a gift of chocolates is not just buying a confection, they are buying the trust and nostalgia associated with the C's name. That is a moat. Second, network effects. This occurs when the value of a product or service increases as more people use it. Think of Visa or MasterCard. The more merchants that accept the card, the more valuable it is to cardholders. The more cardholders there are, the more essential it is for merchants to accept it. This creates a powerful, self-reinforcing moat that is incredibly difficult for a new competitor to overcome. Facebook and Google have similar network effect moats. Third, high switching costs. This is when it is expensive, time-consuming, or risky for a customer to switch from one product to another. Your bank, for example, has a moderate switching cost moat. Changing all your automatic payments and direct deposits is a hassle. Enterprise software companies like Microsoft or Adobe have even stronger moats. An entire company trained on Microsoft Office is not going to switch to a different ecosystem just to save a few dollars. The cost of retraining and the risk of data incompatibility are too high. Fourth, cost advantages. This can come from scale, like Walmart's ability to negotiate lower prices from suppliers than a small local store, or from a unique process or location, like a mining company that owns the richest, most accessible deposit of a particular mineral. When you analyze a company and see a decade of consistently high ROE, your job as a financial detective is to figure out which of these moats, or which combination of them, is protecting that castle of profitability. Your checklist should be brand, network effect, switching costs, cost advantage. Identifying the source and judging its durability is the core of quality investing. It transforms you from a number cruncher into a genuine business analyst, capable of distinguishing a fleeting success from an enduring franchise. To truly cement this lesson, we must again examine the antithesis, the flawed logic that leads so many investors and corporate executives down a path of ruin. This is the growth at any cost fallacy. It is the siren song of expansion, the belief that getting bigger is always synonymous with getting better. This mindset is the polar opposite of the C's Candies model, which prioritized profitable, high-return growth over sheer size. A company caught in the growth at any cost trap becomes obsessed with its revenue line. The CEO wants to be on the cover of magazines, celebrated as a visionary who is building an empire. The board of directors, often compensated with stock options, wants to see the stock price rise, and they believe that rapid expansion is the quickest way to achieve that. So what do? They embark on a relentless quest for growth, often with disastrous consequences for the company's underlying economics. They might slash prices to gain market share, a move that boosts revenue but crushes profit margins, and, consequently, the return on equity. Or they might embark on an acquisition spree, buying other companies to bolt on their revenue. This is one of the most common ways shareholder value is destroyed. The acquiring company often pays too much, blinded by the desire to do a deal. They buy a company in an unrelated industry they don't understand, or they fail to integrate the new company properly, leading to a clash of cultures and operational chaos. You can see this clearly in the numbers. A company might have a wonderful core business with a 25% ROE. Then, it decides to grow by acquiring a mediocre business with a 5% ROE. After the merger, the combined company is much larger, its revenues have doubled, but its overall ROE has plummeted to, say, 15%. The company has gotten bigger, but it has become a worse business. It has diluted its quality. This happens constantly in corporate America. Think of the countless tech companies that, flush with cash from their profitable core business, decide to venture into a completely different, highly competitive field, like building a smartphone or a streaming service. They burn billions of dollars of shareholder capital in a vain attempt to grow, an effort that ultimately fails and destroys the very value they were supposed to be stewarding. An investor who uses ROE as their primary filter can spot this destructive behavior immediately. They can see the trend of a declining ROE and understand that it is a massive red flag. It's a sign that management is more interested in building an empire than in creating value for the owners. The See's Candy's lesson is that the best growth is organic and self-funded, driven by a powerful business model that allows for expansion without compromising the high returns on capital that made the business great in the first place. True value investing is about finding these businesses, not the ones that are simply getting bigger at any cost. The financial magic of the See's Candy's model and the direct connection to your own portfolio growth can be summed up in two words: free cash. A business with a high return on equity and low capital requirements is a fountain of cash. Let's break down the mechanics of this. Think back to our two laundromats. Laundromat A, the 10% ROE business, generates $10,000 in profit. But let's say it's a tough, competitive business. To keep its customers, it needs to constantly upgrade its machines, run promotions, and maybe even expand its floor space just to maintain that $10,000 profit level. It might have to reinvest $8,000 of its $10,000 profit right back into the business just to stay competitive. That leaves only $2,000 in free cash that the owner can actually take out of the business to spend or invest elsewhere. Now consider Laundromat B, the 20% ROE business. It generates $20,000 in profit. Because it has a better location and more loyal customers, an economic moat, it doesn't face the same competitive pressure. It might only need to reinvest $5,000 a year to maintain its equipment and keep things running smoothly. This leaves a staggering $15,000 in free cash for the owner. It generates less profit than Laundromat A needs to reinvest just to survive. This is the financial superpower of a high ROE, moated business. See's Candies was the ultimate example. It required very little capital. Its brand, not its factories, was its main asset. Every year it produced millions of dollars in profit that it did not need for its own operations. This cash was sent to Omaha, where Warren Buffett, acting as the capital allocator, could then take that money and invest it in other wonderful businesses, like Coca-Cola or American Express, or buy whole companies. The high ROE of See's didn't just make See's valuable, it made the entire Berkshire Hathaway enterprise more valuable by providing it with a steady stream of capital to deploy at high rates of return. This is how true portfolio growth is achieved at an enterprise level. For you as a public stock investor, the principle is the same. When you own a share of a company with these characteristics, the management is doing this on your behalf. They are taking the excess cash generated by the business and intelligently reinvesting it, either back into the business if they can earn high returns, or by buying back shares, or by making smart acquisitions. This stream of intelligently allocated free cash is what grows the intrinsic value of the business per share over time. It is a much more powerful and sustainable driver of long-term returns than a simple dividend payment. The dividend is what's left over. The real value creation happens in the efficient reinvestment of the retained earnings, a process that is only possible with a business that generates a high return on equity in the first place. We have seen the beauty of a high return on equity generated by a wonderful business. Now we must turn to its dark side, the deceptive and dangerous twin that has lured countless investors to their doom, the fragility of leveraged ROE. A company's management knows that sophisticated investors watch the ROE number. And for those with weak ethics or a short-term mindset, there is a simple, seductive way to artificially inflate this number and create an illusion of profitability: debt. This danger was laid bare for the entire world to see in the lead-up to the 2008 financial crisis, and no industry provides a more stark and terrifying example than the investment banks themselves. Take a firm like Lehman Brothers or Bear Stearns in the mid-2000s. They were the titans of the universe. Their profits were soaring, their executives were earning astronomical bonuses, and their stock prices were reflecting this incredible success. If you had looked at their return on equity figures, you would have been blown away. Many were reporting ROEs of 20, 25, even 30%. They looked like some of the most profitable and well-run businesses on the planet. But it was a mirage, an edifice built on a foundation of sand. The way they achieved these spectacular returns was through the massive use of financial leverage, which is just a fancy word for debt. Here's how it worked. An investment bank might have $1 billion of its own capital, its equity. But it wouldn't just invest that $1 billion. It would go to the market and borrow another $30 billion. Now it had $31 billion to play with. This is a leverage ratio of 31:1. If they invested that $31 billion in, say, mortgage-backed securities and earned a modest 1% profit, that's a profit of $310 million. But that profit is measured against their original $1 billion of equity. So their return on equity is a spectacular 31%. It looks like genius. But it is an act of breathtaking recklessness. Leverage is a double-edged sword. It magnifies gains, but it also magnifies losses. What happens if those mortgage-backed securities fall in value by just 3%? A 3% loss on $31 billion is a loss of $930 million. This loss is absorbed by their original $1 billion of equity. In one swift move, over 90% of the firm's entire net worth is vaporized. A small tremor in the market becomes an existential earthquake. This is precisely what happened in 2008. When the housing market cracked, the value of their assets fell by a few percentage points, and these highly leveraged institutions were wiped out with terrifying speed. Bear Stearns collapsed and was sold for pennies on the dollar. Lehman Brothers, with over $600 billion in assets supported by a tiny sliver of equity, filed for the largest bankruptcy in history, sending shockwaves through the global financial system. They looked like high ROE businesses, but they were actually low-return businesses using a terrifying amount of debt to create the illusion of profitability. This is the costly market mistake the intelligent investor must learn to avoid at all costs. The catastrophic failure of these financial giants is a dramatic lesson in the power of cognitive biases, particularly the deadly combination of overconfidence bias and recency bias. The executives at these firms, and the investors who bought their stocks, fell victim to the belief that their own intelligence and the complexity of their financial models made them immune to risk. This is overconfidence. They believed they could manage the leverage, that their sophisticated hedging strategies could protect them from any downturn. They had created a system so complex that they themselves did not fully understand its fragility. Compounding this was recency bias, the tendency to give too much weight to recent events and expect the future to look just like the immediate past. The years leading up to 2008 were a period of unusual economic calm and steadily rising asset prices, a period some economists dubbed the Great Moderation. Lulled into a false sense of security by this prolonged period of stability, the banks took on more and more debt. They extrapolated the recent past into the indefinite future, assuming that housing prices would never fall on a national scale. This belief, which in hindsight seems absurd, was conventional wisdom at the time. Leverage acts as a powerful accelerant to these biases. The promise of outsized returns that debt offers is intoxicating. It preys on our greed and our impatience. It makes smart people do foolish things because it allows them to amplify their bets. When those bets are paying off, as they were for the banks for many years, it creates a feedback loop of reinforcement. The high ROE numbers seemed to validate their strategy, their bonuses grew, and their confidence swelled into hubris. They began to believe that the risk had been eliminated, when in fact it was being concentrated to a terrifying degree. The average investor is susceptible to the same psychological flaws. They see a company posting a 30% ROE and are immediately drawn to it, without questioning the source of that return. The high number feels good. It confirms the idea that this is a winner. They don't want to do the boring work of digging into the balance sheet to check the debt levels, because that might reveal an inconvenient truth that contradicts their initial, exciting conclusion. Avoiding this trap requires a conscious act of intellectual humility. It requires you to assume that risk is always present, especially when it seems to have vanished. It requires you to fight against the pull of recency and remember that economic cycles are a permanent feature of capitalism. And most importantly, it requires you to be deeply fundamentally suspicious of any company that generates high returns, primarily through the use of financial leverage. True quality comes from operational excellence, not from a financial tightrope act. How can you, as an individual investor, systematically detect this hidden danger? You need a practical tool, a mental model that acts as your leverage detector. The perfect framework for this is the DuPont analysis, a method developed by the DuPont Corporation in the 1920s to analyze its business performance. It is a simple but brilliant way to deconstruct return on equity into its core components, allowing you to see exactly what is driving the number. The DuPont formula breaks down ROE into three distinct parts. ROE equals net profit margin times asset turnover times financial leverage. Let's walk through this blueprint step by step. First, you start with the headline ROE number. Let's say you're looking at two companies, Company A and Company B, and both have an ROE of 20%. On the surface, they look equally attractive. Now, you apply the DuPont analysis to look under the hood. The first component is net profit margin, which is net income divided by revenue. This measures the company's profitability. How many cents of profit does it keep for every dollar of sales? A high number here is a sign of operational efficiency or pricing power. The second component is asset turnover, which is revenue divided by assets. This measures how efficiently the company is using its assets to generate sales. A high number means the company doesn't need to tie up a lot of capital in factories and inventory to do business. The third component, and the most crucial for our purposes, is financial leverage, which is assets divided by equity. This ratio measures how much the company is relying on debt. If a company has no debt, its assets will equal its equity, and this ratio will be 1. As the company takes on more debt, its assets grow, but its equity doesn't, so this ratio increases. A high number here is a massive red flag. Now let's apply this to our two companies. For Company A, you find its 20% ROE comes from a 10% profit margin, an asset turnover of 1.0, and a financial leverage of 2.0. 10% times 1.0 times 2.0 equals 20%. For Company B, you find its 20% ROE comes from a 4% profit margin, an asset turnover of 1.25, and a financial leverage of 4.0. 4% times 1.25 times 4.0 equals 20%. Suddenly, the picture is completely different. Company A is a high-quality business. It has a strong profit margin of 10%. Its financial leverage of 2 means that for every dollar of equity, it has $1 of debt. This is a reasonable and manageable level. Company B, however, is a much lower quality, more dangerous business. Its profit margin is a mediocre 4%. To achieve that same 20% ROE, it has to employ a much higher financial leverage of 4. For every $1 of equity, it has $3 of debt. This business is a house of cards. It is far more fragile and susceptible to a downturn. The DuPont analysis is your X-ray. It allows you to move beyond the single misleading headline number and understand the true character of a business's profitability. It is the essential tool in your financial statement analysis kit for separating genuine quality from dangerous illusion. The failure to perform this kind of deeper analysis leads the majority of investors down the path of the antithesis, chasing high-yield mirages. Human beings are naturally drawn to the biggest, shiniest number. When screening for stocks, a novice investor will often sort the list by ROE from highest to lowest, and simply start their research at the top. They see a company with a 40% or 50% ROE, and their eyes light up. They think they've found a hidden gem, an undiscovered superstar business. They suffer from a profound lack of professional skepticism. They never stop to ask the most important question: how? How is it possible for this company to generate such an extraordinary return? Is it because they have a patent on a life-saving drug, a brand as powerful as Coca-Cola, and a near monopoly on their market? Or is it because they have loaded their balance sheet with a staggering amount of debt, amplifying a mediocre underlying business into something that looks spectacular? In 99% of cases, it is the latter. A truly wonderful business that can consistently generate an unleveraged ROE of 25% is an economic unicorn, an exceptionally rare find. Companies posting ROEs of 40%, 50%, or even higher, are almost always using high leverage, operate in a volatile cyclical industry, or are experiencing a temporary, one-time profit surge that is not sustainable. The path of the 99% is to take the high number at face value. They get excited, they buy the stock, and they feel brilliant until the economic cycle turns. When a recession hits, the company's revenues fall, but its debt payments remain fixed. This is when the mirage evaporates. The company's profits collapse, the high ROE vanishes, and the stock price plummets. The investor who chased the high-yield mirage is left holding a bag of ashes, wondering what went wrong. The path of the professional, the path of the intelligent investor, is one of skepticism. They view an unusually high ROE not with excitement but with suspicion. It is a signal to investigate, not to celebrate. They would much rather own a company with a stable, consistent 18% ROE that is generated with almost no debt than a company with a volatile 40% ROE that is propped up by a mountain of liabilities. The former is a recipe for sleeping well at night and achieving long-term portfolio growth. The latter is a ticket to a roller coaster of anxiety and, very often, permanent capital loss. Proper debt management is not just a component of good business. It is a prerequisite for survival and long-term success. Choosing the boring, stable, high-quality business over the leveraged, high-yield mirage is a hallmark of a mature and disciplined investment philosophy. The direct financial connection between excessive debt and corporate fragility is brutal and unforgiving. It appears in stark black and white on the balance sheet and the income statement. Let's trace the poison as it moves through the financial body of a company. On the income statement, debt creates an immediate and inflexible cost: interest expense. A company that borrows money must pay interest to its lenders, and this payment is due regardless of whether the company is having a good year or a bad year. It is a non-negotiable claim on the company's earnings. During prosperous times, when revenues are high, this interest expense might seem manageable. But when a recession strikes and sales decline, the interest expense line on the income statement does not decline with it. It remains a heavy, fixed burden. This creates a painful pincer movement. Falling revenues and fixed costs squeeze the company's profit margins, sometimes to the point of generating a loss. On the balance sheet, debt appears as a liability. This liability represents a claim on the company's assets that is senior to the claims of the owners, the shareholders. In a worst-case scenario, if the company cannot make its interest payments, the debt holders can force the company into bankruptcy. In a bankruptcy proceeding, the lenders get paid first from the sale of the company's assets. The shareholders, the owners of the company, are last in line. Often, they get nothing. This is what financial fragility means. A company with a huge amount of debt has very little room for error. A small business mistake, an unexpected economic downturn, or a sudden rise in interest rates can trigger a cascade of events that can wipe out the entire shareholder equity of the firm. In contrast, a company with little or no debt is financially robust, or what the writer Nassim Taleb would call anti-fragile. It has a huge margin of safety. If a recession hits, it doesn't have the crushing burden of interest payments. It can survive. Better yet, it can play offense while its leveraged competitors are struggling to stay afloat. It can use its strong balance sheet to buy assets from distressed rivals at bargain prices, to gain market share, or to invest in research and development for the future. The absence of debt is not just a defensive measure. It is a powerful strategic weapon. When you perform your financial statement analysis, you are not just looking at numbers. You are assessing the very resilience and survivability of the enterprise. Choosing companies with clean balance sheets and low debt is the essence of the Warren Buffett method. It is a conscious decision to trade the illusion of spectacular, debt-fueled returns for the reality of durable, high-quality, and much safer long-term compounding. Having navigated the perils of leverage, we now arrive at the most rewarding part of our journey, understanding the beautiful, powerful mechanics of the compounding engine. This is where a high, unleveraged return on equity transforms from a simple measure of profitability into a dynamic force for exponential portfolio growth. The perfect case study for this principle is Warren Buffett's single greatest investment, his purchase of shares in the Coca-Cola Company. The year was 1988. The stock market had suffered a brutal crash in October of the previous year, and investors were gripped by fear. But where others saw danger, Buffett saw an opportunity of a lifetime. He had been watching Coca-Cola for decades. He saw a business with a deceptively simple product, but with economics that were nothing short of sublime. Coke had a brand that was recognized and beloved in every corner of the globe. This gave it a powerful economic moat. Its business model was also capital light. It didn't own most of the hugely expensive bottling plants. It sold concentrate to independent bottlers, a fantastically high-margin business. The result of this perfect combination was a business that generated a consistently high return on equity, often well over 30%, and it did so with a strong balance sheet. Between 1988 and 1989, Berkshire Hathaway invested approximately $1.3 billion, acquiring a substantial stake in the company. What happened next is a masterclass in the power of compounding. Coca-Cola, the business, was a machine for turning its own equity into more equity. Each year, it would generate billions in profit. It would pay out a portion of that as a dividend, and it would retain the rest. This retained money would be added to its equity base, and the following year, Coke would earn its high rate of return on this newly expanded capital base. It was a virtuous cycle. The business was growing its own intrinsic value at a rapid rate, year after year, without needing to borrow money or sell more stock. It was a self-fueling rocket ship of value creation. For Buffett, the investor, the result was staggering. The dividends he received from Coca-Cola grew and grew. By the late 1990s, the annual dividend Berkshire received was more than half of its original cost basis for the entire investment. The market price of the stock also soared, as it inevitably followed the relentless upward march of the company's underlying value. That $1.3 billion investment has since grown to be worth over $25 billion today, and it has paid Berkshire billions upon billions in dividends over the decades. This wasn't because Buffett was a brilliant stock trader who timed the market perfectly. It was because he was a brilliant business analyst who identified a company with a superior economic engine and then had the patience to simply sit and let that engine do its work for him. He bought a compounding machine and let it compound. That is the ultimate secret to long-term wealth creation. The incredible story of Buffett's Coca-Cola investment reveals a fundamental weakness in the human brain, a cognitive glitch that prevents most people from ever achieving this kind of success: the exponential growth bias. Our minds evolved in a world where most things were linear. If you walk for an hour, you cover a certain distance. If you walk for 2 hours, you cover twice that distance. Our intuition is built for linear relationships. But the mathematics of compounding are exponential, and this is something our brains are notoriously bad at grasping. Let me illustrate with the classic riddle. Would you rather have $1 million today or a single penny that doubles in value every day for 31 days? The linear thinking brain screams, "Take the $1 million!" A penny seems worthless. After a week, that penny has only grown to 64 cents. After 2 weeks, it's only $81. Even after 20 days, it's just over $5,000. The $1 million still looks like the genius choice. But then, the magic of exponential growth takes over. On day 30, your penny becomes $5.3 million. And on the final day, day 31, it doubles one last time to $10.7 million. The exponential growth curve is deceptive. It starts off incredibly slowly, almost flat, and then it goes nearly vertical. A company with a high return on equity is like that doubling penny. Its ability to reinvest its earnings at a high rate of return creates an exponential growth trajectory for its intrinsic value. In the first few years, the effects might not seem dramatic. But over a period of 10, 20, or 30 years, the results are world-altering. Most investors lack the patience to see this process through. They get bored during the early, flat part of the curve. They are looking for the instant gratification of a quick stock pop. They sell their high-quality compounder after a year or two to chase some other exciting story, never allowing the exponential magic to take hold. Buffett's genius is as much about temperament as it is about intellect. His ability to understand the math of compounding is matched by his psychological fortitude to sit patiently and let it work for him over decades. To become a successful long-term investor, you must fight your brain's linear intuition. You have to learn to truly appreciate the power of that upward sweeping curve and develop the patience to ride it. How can we translate this understanding of compounding into a practical mental model for our own stock picking? We can use a simple but powerful formula to estimate a company's potential for internal growth, a concept I call the owner earnings reinvestment calculation. The formula is this: the sustainable growth rate of a business is equal to its return on equity multiplied by its retention ratio. The retention ratio is simply 1 minus the dividend payout ratio. Let's break this down into a step-by-step blueprint. First, find the company's return on equity. You want to look for a company with a consistently high ROE, preferably over 15%, and you want to look at the average over the last 5 or 10 years to make sure it's stable, not a one-year fluke. You can find this data on any major financial website. Second, find the company's dividend payout ratio. This is the percentage of its net income that it pays out to shareholders as dividends. This can also be found easily on financial data sites. Third, calculate the retention ratio. If a company has a payout ratio of 30%, it means it is retaining the other 70% of its profits to reinvest back into the business. So its retention ratio is 70%, or 0.7. Now you simply multiply the two together. Let's take a company with a stable 20% ROE and a retention ratio of 70%. Its sustainable growth rate is 20% times 0.7, which equals 14%. This number is incredibly powerful. It represents the rate at which the company can grow its intrinsic value per year, using only its own internally generated funds. It doesn't need to borrow money or sell more stock. It is a self-funding growth machine. Compare this to another company. This one has a lower ROE of 10%. It also has a higher dividend payout ratio of 60%, meaning its retention ratio is only 40%. Its sustainable growth rate is 10% times 0.4, which equals a mere 4%. The first company is growing its underlying value at 14% per year. The second is growing at only 4%. Over a decade, the difference in the growth of their book value and earning power will be immense. This simple calculation is a cornerstone of fundamental analysis. It allows you to peer into the future and estimate the velocity of a company's value creation. It's a tool that helps you move beyond just identifying a good business today and toward identifying a business that has the engine to become a much better business tomorrow. It is the mathematical blueprint of the compounding machine. This focus on a company's ability to reinvest its own earnings at a high rate stands in stark contrast to the approach taken by the 99% of investors, many of whom fall into what is known as the dividend trap. This is a particularly common mistake among retirees or those seeking to generate income from their portfolios. Their process is simple. They screen for stocks with the highest dividend yields and buy those. On the surface, this seems logical. A 5% dividend yield feels like a solid, tangible return, but it can be a dangerous and misleading metric. A high dividend yield is often a sign of a business that is in deep trouble, or, at best, one that has run out of growth opportunities. Think about it from the company's perspective. The only reason for a company to pay out a very large percentage of its earnings as dividends is that its management has concluded that they have no better use for that cash. They can't find profitable projects inside the business to reinvest in. This is a sign of a stagnating, low-return enterprise. The company is, in effect, liquidating itself slowly by paying out all of its profits instead of building for the future. An investor who buys this stock for its high yield might receive a steady stream of income for a while, but the underlying value of the business is likely eroding. The stock price will probably go nowhere or even decline over time, and a cut to that precious dividend is a constant threat if the business runs into any trouble. The intelligent investor, the one focused on total return, understands this. They would much rather own a company with a lower dividend yield, or even no dividend at all, provided that the company is retaining its earnings and reinvesting them at a high rate of return. Let's go back to our example. The first company, with the 14% sustainable growth rate, might only have a 1% dividend yield. The second company, with the 4% growth rate, might have a 5% dividend yield. The income-focused investor would choose the second company. But the total return for the first company is its 1% dividend yield plus its 14% internal growth rate for a total expected return of around 15%. The total return for the second company is its 5% dividend yield plus its 4% growth rate for a total expected return of only 9%. The superior long-term investment is clearly the low-yield, high-growth compounder. The dividend trap is a classic case of winning the battle but losing the war. It provides a short-term psychological comfort of income while often sacrificing the far greater prize of long-term capital appreciation, which is the true engine of building life-changing wealth. The direct financial connection of this compounding power is the relentless, beautiful growth of a company's book value per share. Let's revisit the balance sheet to see how this wealth creation is mathematically recorded. Shareholder equity, or book value, is the net worth of the business. When a high ROE company retains its profits, that money flows directly into the shareholder equity account on the balance sheet, increasing the net worth of the company. Because this is happening on a per-share basis, what we are really interested in is the growth of book value times per share. Imagine our 20% ROE company from before. It starts the year with a book value of $10 per share. It earns a 20% return on that, which is $2 in profit per share. It decides to retain all of those earnings. So at the end of the year, its book value per share is now $12. It has grown by 20%. In year 2, it earns 20% on this new higher base of $12. That's $2.40 in profit. It retains that, and its book value grows to $14.40 per share. This process repeats, year after year. The book value is compounding. Now, why is this so important for you, the shareholder? Because over the long run, there is a very strong correlation between the growth in a company's book value per share and the growth in its market price per share. In the short term, stock prices can be irrational, driven by fear and greed. But over the long term, the market is a weighing machine. It recognizes the creation of real, tangible economic value. A stock cannot forever trade at a price that is disconnected from the growth of its underlying business value. So as that book value per share steadily marches upward at a high rate, the stock price will inevitably be pulled along with it. Let's chart this out. Take a high ROE company compounding its book value at 15% per year, and a low ROE company compounding its book value at 5% per year. In year 1, the difference is not that dramatic, but after 10 years, the high ROE company's book value will have more than quadrupled, while the low ROE companies will have only grown by about 60%. After 20 years, the difference is astronomical. The chart shows two lines diverging, with the gap between them widening exponentially over time. That widening gap represents the tangible wealth that is being created for the shareholders of the superior business. This is how beating the market is achieved. It's not about predicting stock charts. It is about identifying businesses that are on that steep, upward-sloping line of value creation and having the discipline to hold on for the ride. The growth in book value per share is the financial footprint of the compounding machine at work. We have now come to the final pillar, the point where we synthesize all this knowledge into a practical, actionable framework. This is the investor's X-ray, a systematic guide to applying the ROE filter to your own stock analysis, allowing you to scan the market and identify truly great businesses with clarity and confidence. To illustrate this process in action, let's look at another one of Buffett's legendary investments, the Washington Post Company. In the early 1970s, the newspaper industry was deeply out of favor. Investors were terrified of the rise of television news, and newspaper stocks were trading at ridiculously cheap prices. But Buffett, applying his analytical framework, looked past the gloomy headlines. He saw that the Washington Post wasn't just a newspaper. It was a media empire with a collection of dominant, high-return assets. The newspaper itself had a virtual monopoly in its market, giving it immense pricing power with advertisers. The company also owned several network television stations which were, in his words, licenses to print money. They required almost no capital and gushed cash. When Buffett performed his stock analysis, he wasn't just looking at the reported earnings, which were respectable. He was looking at the underlying economics of the business, its return on the capital actually invested. He saw a business that was a cash-generating machine, protected by a deep economic moat of local monopolies and powerful brands. It was a high ROE enterprise that the market, in its panic, had completely mispriced. He invested a significant portion of his partnership's capital, buying shares for a fraction of their intrinsic value. Over the next decade, that investment would grow more than 100-fold, becoming one of the cornerstones of Berkshire Hathaway's wealth. The story of the Washington Post is the perfect example of using a quality-focused lens to find value where others see only fear. Buffett used his understanding of business economics, his X-ray vision, to see the healthy, profitable skeleton underneath the skin of a troubled industry narrative. This is the level of analysis we are aiming for, not just finding a high ROE, but understanding why it's high and whether that reason is durable. This systematic, quality-first approach is also a powerful antidote to one of the most destructive psychological traps in investing, confirmation bias. This is our natural human tendency to search for, interpret, favor, and recall information in a way that confirms our pre-existing beliefs. In investing, it works like this. You hear a good story about a stock, perhaps from a friend or a TV pundit. You get excited about the company's prospects. You have now formed an initial positive belief. Then, you begin your research, but you're not really researching with an open mind. You are subconsciously looking for data and opinions that support your initial thesis. You'll give more weight to the bullish analyst report and dismiss the bearish one as biased. You'll focus on the company's revenue growth and ignore its deteriorating balance sheet. You fall in love with the stock, and your research becomes an exercise in justifying that emotional commitment. This is a recipe for disaster. It's how people end up with concentrated positions in speculative companies that ultimately blow up. The way to combat this is to adopt the mindset of a scientist, not a lawyer. A lawyer starts with a conclusion and builds a case to support it. A scientist starts with a hypothesis and then tries relentlessly to disprove it. An investment checklist, a concept championed by Buffett's partner Charlie Munger, is the investor's tool for being a scientist. A checklist forces objectivity. It's a predefined set of criteria that a company must meet before you allow yourself to get emotionally invested. It short-circuits confirmation bias by forcing you to confront the cold, hard data first. And at the very top of any quality investor's checklist should be a screen for return on equity. By starting your process with a quantitative filter, for example, I will only investigate companies that have an average ROE of over 15% for the last 10 years with manageable debt. You immediately narrow the universe of thousands of stocks down to a few hundred candidates that have at least demonstrated a baseline of quality and profitability. Only then do you begin the deeper qualitative work of understanding the business and its moat. This approach ensures that you are fishing in a pond stocked with high-quality fish. It protects you from falling in love with a good story about a bad business, a psychological flaw that has destroyed more wealth than any market crash. So let's build the ultimate practical blueprint for applying this knowledge. I call it the three-lens ROE framework. This is your step-by-step guide to using ROE like a professional. Every time you analyze a company, you will look at it through these three distinct lenses. Lens 1 is the level. The first question you must ask is the return on equity consistently high? We're not interested in a company that has one good year. We are looking for a long-term track record of excellence. You should look at the ROE for the last 10 years. Is it consistently above a certain threshold? A good starting point is 15%. Warren Buffett has said he looks for businesses that can earn at least this much on their equity. A company that has maintained an ROE above 15% for a decade has proven it has some kind of durable competitive advantage. Lens 2 is the trend. The second question is, what direction is the ROE heading? Is it stable, is it increasing, or is it decreasing? A stable and high ROE is a great sign. An increasing ROE can be even better, suggesting the company's competitive position is strengthening. But a declining ROE is a major red flag, even if the absolute level is still high. A company whose ROE has fallen from 30% to 20% over the last 5 years might still look good on the surface, but the trend tells you that its moat is being eroded by competition or that its management is making poor capital allocation decisions. The trend often tells you more about the future than the current level does. Lens 3 is the source. This is the most critical and final question. Where is the ROE coming from? Is it being driven by genuine business profitability, or is it being artificially inflated by dangerous levels of debt? This is where you bring in the DuPont analysis we discussed earlier. You must break the ROE down into its components: net profit margin, asset turnover, and financial leverage. You are looking for companies that generate their high ROE through high profit margins, or efficient asset turnover, not through high financial leverage. A financial leverage ratio, asset/equity, consistently below 2.5 is a good sign of a conservatively financed business. You can find all the data you need to perform this 3-lens analysis for free on websites like Yahoo Finance, Morningstar, or Macro Trends. By systematically applying this framework, checking the level, the trend, and the source, you will develop a powerful X-ray vision. You will be able to quickly separate the wheat from the chaff, the true quality compounders from the fragile, leveraged pretenders. This repeatable process is your personal system for executing the Warren Buffett method. Before we conclude, we must address the final antithesis, the opposite path that even some diligent investors fall into: analysis paralysis. In the age of infinite information, it is easy to get overwhelmed. You can pull up a company's financial data and find hundreds of different ratios, metrics, and data points. Some investors believe that the key to success is to analyze every single one of them. They build monstrously complex spreadsheets, they read every analyst report, they listen to every conference call, and they get lost in an ocean of detail. They become so focused on the minutiae that they lose sight of the bigger picture. They spend so much time analyzing that they are too paralyzed by the complexity to ever make a decision. The beauty of the ROE framework is its elegant simplicity. It is an application of the 80/20 rule, also known as the Pareto principle. This principle suggests that for many events, roughly 80% of the effects come from 20% of the causes. In investing, a few key financial metrics drive the vast majority of long-term returns. Return on equity, when properly understood and deconstructed, is arguably the most important of them all. It acts as a powerful first-pass filter. It is not the only thing you should look at, but it should be the first thing you look at. By using the 3-lens ROE framework, you can quickly and efficiently screen out the vast majority of mediocre and dangerous companies. You can take a universe of 10,000 stocks and narrow it down to a few hundred interesting candidates in a very short amount of time. This frees up your valuable mental energy to focus on the much more difficult, qualitative work of understanding the economic moats and management quality of this much smaller group of high-potential businesses. Don't seek to know everything. Seek to know the few things that truly matter. Mastering the story that return on equity tells, the story of profitability, efficiency, and financial prudence, is far more effective than drowning in an ocean of less important data. It is the key to moving from analysis to action, and from action to results. Finally, we arrive at the direct financial connection that ties all of this together, the link between a high-quality, high-ROE business and its valuation. A common refrain from novice investors is that great companies are always too expensive. They look at a business like Coca-Cola or Microsoft, see its high price-to-earnings ratio, and conclude that it's overvalued. This is a fundamental misunderstanding of the nature of value investing as it is practiced by the modern Warren Buffett. The truth is, a business that can consistently compound its intrinsic value at a high rate deserves to trade at a higher valuation multiple. It is a superior asset, and it commands a premium price for a good reason. Think of it like buying real estate. A shabby, run-down house in a declining neighborhood might sell for a very low price-to-rent multiple. It looks cheap, but it's cheap for a reason. A beautiful, well-maintained apartment building in a thriving, growing part of the city will sell for a much higher multiple. It looks expensive, but its rents are rising, its value is appreciating, and it is a much safer, more profitable long-term investment. The same is true for stocks. The cheap, low ROE company is like the rundown house. The high ROE compounder is like the prime apartment building. Paying a fair price for the compounding power of a wonderful business is the essence of quality investing. The financial transformation this knowledge enables is profound. You stop looking for statistical bargains and start looking for economic partnerships. You are not just buying a stock. You are buying a fractional ownership stake in a superior economic engine. The high and stable ROE is the number that reveals the horsepower of that engine. It tells you how quickly that business can grow its own value over time. And when you buy that business at a reasonable price, you are positioning yourself to have your own capital compounded at that same high rate for years or even decades to come. This single metric, when understood in its full depth, allows you to identify businesses with superior profitability, check for the hidden risks of debt, project their future growth, and finally, make an intelligent judgment about the price you are willing to pay. It is the closest thing we have to a master key for unlocking the secrets of the world's greatest businesses. You have just invested a significant amount of your time and attention, and in doing so, you have acquired more than just information. You have installed a new piece of mental software, a powerful analytical lens that allows you to see the market with the clarity of the world's greatest investor. The three-lens ROE framework, analyzing the level, the trend, and the source, is now part of your intellectual arsenal. You can now look at any business and, within minutes, assess the quality of its economic engine and detect the hidden dangers that trap 99% of other investors. This is a tangible skill, a financial superpower that will serve you for the rest of your investing life. But what you have mastered today, as powerful as it is a single crucial node in a much larger network of mental models. The Warren Buffett method is not a single trick. It is an interlocking system of principles, a latticework of ideas that support and reinforce one another. Understanding a company's return on capital is a vital first step, but it connects to deeper questions of competitive advantage, management integrity, and valuation. You have just been given a detailed map of a single, wealthy province, but there is a whole continent left to explore. The video that is now appearing on your screen is not a random suggestion. It is the next piece of that map. It is the link that connects what you have just learned about identifying a great business to the next critical component in this system of thought. Think of it as the bridge from one province to the next. The journey to true financial mastery is a continuous one, a process of layering one powerful concept on top of another until a complete, unbreakable structure is built. The choice you have right now is not simply whether to watch another video. It is a choice about who you want to become. Do you want to remain a tourist, collecting a few interesting souvenirs of knowledge? Or are you ready to continue the ascent, to become a true architect of your own financial future by methodically acquiring every tool you need to build it? The next piece of the blueprint is waiting. The decision to continue is yours.